and with me I have Jonathan. I guess real quick we can introduce ourselves. I'm from the Washington, D.C. area. My background is in blockchain product management. I used to work for Block One, the people that made EOS, and I currently work for NEM Group. They created Symbol and NEM, one of the oldest blockchains that exist. My experience kind of comes from formulating all the strategy around the blockchain and a token, and then helping developers understand the business ramifications and helping the business people understand technical ramifications. So I'm kind of in the middle of that stack. And Jonathan, you want to go?
Cool. Yeah. I have a background in brain-machine interfaces and worked at a couple of startups. Currently in a master's program and wanted to get into blockchain, so I am currently helping MPA as a crypto research intern.
Awesome. All right, so let's get right into it. So first off, wait, Jonathan, if you want to take
Yeah, sure. So yeah, I guess to start off, what is a token exactly? There are a lot of things that we generally exchange, but we have our own kind of versions of tokens, like fiat currencies are tokens in some way, shape, or form. However, kind of having to live in the analog world, there are a lot of issues that we've had as well, especially since it's being managed by the Federal Reserve. There are pros and cons to that, but the idea of tokens now, since the blockchain world has emerged since 2009, we can basically choose our own and create our own incentivization structures to manage different organizations or social structure or social agreements that we want to partake in. But the basics of a token is this digital asset or digital kind of currency that can be exchanged. They can be fungible or they can be non-fungible. Yeah, next slide.
Sure. So why do companies use tokens? So unlike centralized apps where there's more active governance, like a manager telling you to do something, in decentralized systems, all you have are passive tokenomics, governance, and incentivization. So in an application like Facebook, every eyeball is monetized, but the earnings are fully controlled by a centralized company. So then there's movements around decentralized social media, and there's coins like Steemit, which is really old. There's newer ones like Trodel, I think it's called, that are focused on giving users back the value that they're generating. Because you as a user, every time you're on Twitter and you scroll past a promoted ad, if you even stop for a little while, the person is paying. The person who tweeted that is paying Twitter. So now Twitter is monetizing off you as a user. So what blockchain allows you to do is to create an open governance and incentivization system where those users can now be rewarded for partaking in the economy that only exists because of their participation. So it helps users realize their value and their importance. And that's one of the coolest powers of a token, creating user-centric business models that aren't focused on only the business growing, but if you reward the users, your business will grow at a rate that's exponential compared to if you weren't.
So what are tokenomics? This diagram on the right-hand side is a simple way to kind of get started with creating your own tokenomics framework. So you can kind of split it up into three different categories with three different kind of structures within each to start your questioning of so that you can optimize the tokenomic structure that you're going to be building. Obviously, they are all blocky here, but the idea is they're all pretty interrelated. So I guess there's probably some, and I'm going to be using this particular framework throughout the presentation, just so we can kind of have something, some reference structure to refer back to. But just some very basic background about, or to kind of cover some of the terms here. Thickness in this particular case just means scale. So how many people are on the network. Congestion is obviously just like is just like the transactions per second or something, if that's what you're interested in. If it's non-fungible tokens, obviously transaction or like congestion may be less important. But obviously that's also dependent on the blockchain that you're building on. Safety would be consensus protocol. Governance would be voting structure. You'd have like the different incentive structures. You'd have the token policy, which would be monetary policy. Structure and architecture would just be different ways in which rewards or such would be disseminated to the rest of the structure. So we'll be touching base on this, using this structure to roughly describe how different blockchains have built their tokenomics, using this as a guide.
Cool. So economics versus tokenomics. So it's I know the words are similar and they are in essence and in theory very, very related. Tokenomics derive from economic thought. So the main goals between the two, economics are normally used for predictive goals, where tokenomics are used for design goals. They're used to design systems using economics. And economics obviously designed around predicting the future. So the general approach for economics is, given these rules, what outcomes can we expect? Well, for tokenomics, it's given this desired outcome, what rules should we create? So it's a flipped mindset of thinking. So economics would answer questions like, if the price of oil increases, will electricity prices go up or down? While tokenomics is, given our desired user adoption for the network, should we give our coin supply a fixed cap? And maybe something more related to the oil example would be, if you want the price of oil to stay the same, that's your goal. So instead of if the price of oil increases, I want the price of oil to always be $1. What needs to happen to the price of electricity? How do I control that? So that's how creating a stablecoin in essence works. It's, how do I control the stability of the supply to achieve the optimal price of this decentralized asset? So I know this is like a loaded slide, and there will be time for questions at the end, so we can go into all of that later.
So understanding our stakeholders. So obviously in a decentralized network, there's going to be the people that just want to use the platform for whatever it produces. You're going to have the initial developers or the founders who basically built the platform that might, after they launch it, they might continue to build projects and put it up to have the system vote on the projects that they're outputting. And then you have other contributors who, after the platform is built, they might also want to kind of contribute and build their own projects to be added to the system. But yeah, also from an investment perspective, you would have contributors. So like for the blockchain network, you would have miners, for example, that would basically help produce every single block. And then you have like the initial developers, for example, that might just be Satoshi Nakamoto, who basically built Bitcoin.
So transition into this, now that we're talking about tokenomics, why they exist, and kind of how they work. What are the tokenomics of the dollar? So this is a currency that we all traditionally use. So this is kind of, if you're looking at a token, you're reading a white paper, these are kind of basic questions to ask yourself. So obviously we know the white paper isn't a token, right? So it's not a one-to-one comparison, but it is something that we can still use as an example. So some of the questions are like, what's the total supply? How is burning and minting controlled? What's the allocation of the supply? What's the governance system? And why was it created? What's the utility? So here, actually, Jonathan, if you want to go into this.
Yeah, sure.
Yeah.
So for the dollar, the Federal Reserve basically has a monopoly on the minting and the destruction of the dollar, basically. All other anyone else who does it is effectively breaking the law. So they technically have a quote-unquote infinite printing supply, but the idea is we ultimately need this currency to sustain the economy. And they will print as much as needed without collapsing the entire system, even though it might, for example, in recent times where the dollar is heavily inflated, they are printing as much as they think is necessary to kind of like keep things afloat in ways that they think are necessary, even though it might hurt us in the long run. They are trying to save things from collapsing in the short term. Burning and minting, we kind of covered that. How is allocation of monetary supply determined? So I guess in this particular case, newly minted coins are distributed to major whales who have a significant stake in the system, and this basically is true of any group that basically mints the currency. So whether it's you can build it into with like the Federal Reserve, for example, pretty much anyone who works in banking and in finance generally has a lot more money than and access to it than other people. But in blockchain and cryptocurrencies, you generally people when they create and mint and create new coins, they will generally reserve resources for themselves. And then what is the governance system? So we have, for the Federal Reserve, we have 3 government officials and 6 basically community whales that will control the rate and the amount of coins that are minted. And then context for its creation. So we, currency-wise, we've kind of come a long way from maybe like seashells to gold to, the dollar to kind of having them paired together to where it is right now. And since Bretton Woods and such, the U.S. dollar has become both the world reserve currency as well as the national currency, which recently has been problematic because of the problems in the U.S. We have needed a currency. We needed to print more money to solve some of the problems as a nation, but the problems with us printing more money doesn't just affect the nation, it actually affects the entire world because lots of other countries have their financial stability pegged to the dollar. So this is also things that, from an ecosystem perspective, you can see how creating tokens and such might lead to very interesting circumstances in the long run.
Yeah. I like to caveat this with, if you see tokenomics like this, it's normally not something you invest in. So when a token is like brand new, obviously this has the weight of the entire US government behind it. So the US dollar is different. If you look at the context of its creation, the US dollar was backed by gold at first. It got off the gold standard and then started being backed by international oil trade because there was a deal done between OPEC, the countries that produce 80% of the oil that's sold and traded throughout the entire world, that only US dollars can be used for that oil. And that was in the 70s. So since then, oil trade has greatly backed the international value and the international value of the US dollar. So now that we're moving towards renewable assets, we're not using as much fossil fuel, consumers are becoming aware of the problems of the oil industry and using oil, what is next? And that's where we see use cases like the Chinese yuan starting to become digitized and central bank digital currencies popping up, which is a really interesting topic, but we'll get into that later, not today. So tokenomics questions to consider. How many coins? So these are examples of stuff to think about while you're building your own tokenomics systems, and while you're maybe reviewing other projects. So while you're looking at maybe a sponsor's project, or you're just looking at a random coin out there that one of your friends recommended to you. How many coins or tokens currently exist? How many will exist in the future, and when and how will they be created? Who owns these coins? Are there some set aside to be released in the future to developers? And how will you incentivize the engagement in an ecosystem? And is there any information to suggest that a large number of coins has been lost, burned, or somehow unusable? This is important. So these questions, these last four these first four questions are about the circulating supply and understanding how many are held by individuals, how many are locked up, how many are at risk of being sold. Because sell pressure is what causes a token to go down in price. And then lastly, what is the utility of a token? What does it do? This is normally where the buy pressure comes from. This is where a lot of the demand outside of price speculation, it comes from people trying to access the utility of the token.
So Bitcoin is the first token that was created using blockchain. And so it both performs as a platform, but also as an incentive. So this is kind of where we talk about have this relationship between people that are using the platform and people that are miners. And the interesting thing is, like, even though Bitcoin was the first of its kind, and it's been around for 12 years now, it still had quite limited adoption and change due to its tokenomic structure. So maybe we can learn a thing or two from Bitcoin. So the problem with Bitcoin right now is it uses proof of work. And it uses this miner rewards incentivization structure that, as of right now, it seems to have a really congested network. Since the original white paper was for it to be meant to be the payment rails that's going to replace a lot of the financial institutions that we have today. A lot of these choices that they had made earlier on prevents it from being the transaction network or the monetary network that it was hoping to become originally. So an example of what its competition is, like Visa, where it has a transaction speed of 1,700 per second, and it processes 150 million transactions per day. Bitcoin currently has a throughput of about 5 transactions per second and only processes 0.2 million transactions per day. So the idea is it has a problem with scaling, and that is due to its tokenomic structure, where you have proof of work ends up being very energy intensive. The algorithms that it kind of requires are too slow. And then the more people that come online requires more mining power, which requires more energy. And so ultimately it ends up taking a lot more energy and time to do fairly, I guess, like what we have become used to being fairly simple. And because of this, as more people come onto the network, the network gets slower and more expensive. Instead of becoming a payment system, Bitcoin has just become digital gold because it's more profitable to just hold the asset as opposed to try to use it to transact. And so even though and I guess to kind of a caveat to that is Ethereum is also using proof of work. It's smart contract based, but even these days we're seeing severe congestion problems where, again, since most people since there's so many people on it, the gas prices have gotten incredibly high, and it's harder to kind of get. It's become slower in certain ways, but even if it's smart contract based, it's just like you can kind of see there are similarities in terms of choices of even a consensus protocol that would affect the outcomes of your system.
I think
You're muted.
I thought Pluto.
Oh, my bad. Sorry about that. But so next up we have PlutoPepe, who are a sponsor for this event, but their project is also a very good example of a modern coin modern token, that's built on Binance Smart Chain, and it uses something called a token tax. So Pluto incentivizes buying and holding through a token tax that's hard-coded into their token contract. So every time a transaction is sent, so let's say I send Jonathan 100 Pluto, 10% of that is taken out as a tax. And so out of that 10%, some is burned, some is provided as liquidity, and some is distributed back to users. So out of that 10%, 1.25% is burnt, 5% is put onto PancakeSwap as liquidity, and then 3.75% is distributed back to all the token holders. So there's like an automatic yield that's tied into the velocity of the token. So the more popular the token gets and the more people that buy into the vision and the ecosystem, the more holders are innately rewarded. But also holders are punished for trying to sell or move their Pluto. So there's a 10% tax. So if you wanted to sell, if you were an arbitrage like bot and you buy in and sell, you're losing 20% on both ways. So it normally incentivizes a lot more people to buy in and it punishes selling. So it kind of slows down the dump a little bit, which is helpful in a lot of token economic senses because you have to worry about how your token is performing on the market. So some of the ways you keep a token alive and you build an economy and an ecosystem is through utility. And I know we mentioned utility earlier. So PlutoPepe is an example of this. Since they know that tokens can't survive simply through economic incentives, which is the tax, like any app or product, it needs to solve a problem or add value for a user. I think that's something that's really important to understand. A token just existing doesn't mean anything. It needs to actually, like any app or any product that you're trying to build, it needs to solve something or it needs to add a value for a user for anyone to consider it a worthwhile place to put their money. So PlutoPepe specifically is utilizing their token as the basis for a decentralized app called PepeSwap. And that is a DEX that has farming, pools, they're working on gaming, and they also have their own governance system. So it's a full suite decentralized app that has a lot of different utility, and it's focused a lot on yield and providing rewards. So that's one way you can kind of look at utility and look at how you can build in an economic incentive along with a utility.
So DevXDao is another project that we've been keeping close tabs on. They are an engineering guild that we have been using to study their governance structure. So Roshaan was just talking about a utility coin. This group has a governance coin. So how do you create a token based off to manage governance? And so I'm going to start off with a handful of questions. But the idea is, first of all, what kind of governance are you interested in, centralized or decentralized? And since we're talking about blockchain, most people are much more interested in trying to create more decentralized forms of structures and trying to see what they can do with those. But the problem with decentralized forms of governance is that people are trying to figure out the best ways to govern decentralized for DAOs, for example. But they also have to best manage problems like the tragedy of the commons, from the idiocy and the tyranny of the mob, while eliciting the wisdom of the crowd and its experts. So it's just how do you also make sure that, like, once you kind of decide on the direction that you want to take things, how do you want people to behave, and how do you even determine that? And then, so whether or not you want people to just buy a coin and then just hold it for a long term, or you want to elicit a community that seems to that's more prone to volunteer than others. So you can kind of like use the tokenomics to tweak incentives so that to promote different sorts of activity. And then the ways that you have to enforce things is different than most centralized structures, where you would basically have to rely more on reputation monitoring and like agreed upon sanctions or punishments, an incentivization structure, and basically maybe like build into, and then overall it has to be based off of people wanting agency, and then also there have to be some sort of like underlying values that people would actually keep using the system. The U.S. government, for example, is actually some combination of the two, of centralized and decentralized, and most likely we won't, even though most decentralized structures right now ultimately have a bad habit of becoming centralized. I guess a lot of the theory behind trying to create a very sustainable decentralized structure is still under research, but we need more robust kind of ways of understanding how to combine the two, so that you can actually have a decentralized structure, sustainable one that can also include centralized structures within it. And I guess the U.S. uses a combination of capitalism and socialism, and also we use a one person, one vote voting system. But as we know, that can also be problematic. Next.
Okay.
So now we have the actual DevXDao kind of like governance structure, where they basically, after kind of going through, if you wouldn't mind clicking one more time.
Oh, sorry.
Yeah, there we go. So DevXDao uses a hybrid centralized and decentralized governance structure. And from all the research, pretty much, at least from a voting perspective, this is kind of the 6 tenets that kind of follow through. So as you can also see, so first is it's a reputation-based system, and the way that you would get reputation would be to propose a project that would be good for the entire ecosystem, and hopefully it's like will have long-term value. And so when you propose a project, you would get some sort of reputation NFT minted. With NFT reputation tokens, with these NFTs, you would have voting rights. So any projects that come on, or whether or not you are trying to help with quality control, you basically have more of a say if once you have these reputation tokens. And the idea is that they follow a 2-vote model, which just means that there are projects in which you can vote loosely or tightly, which means that you're either going to stake your reputation tokens or they're going to be unstaked. So if you feel strongly about something, you might more tightly you might stake your tokens because you want something to happen. But the idea is if you lose, you might lose those tokens that you have earned. So the idea is like if you care about something, like you'll put something on the line. But if you just kind of like loosely vote on something, then there's less on the line, which means that your vote will cost less. Will count less. So this is a weighted democracy. Once you kind of like earn the right to vote, and then that kind of transfers down to this voting engine, where the total amount that is to be rewarded is basically split at 50-50 at first. So the way that you vote, just say like you have like Alice and Bob that are pro, and then you have Steve and Sherry that are against. And so everyone, like the pros and the cons, will start at 50-50, and depending on how many reputation tokens they vote to kind of like affect the balance, will determine who the winner is. And the idea is whoever wins. Basically, if you lose, the amount of reputation tokens that you invested will be kind of divvied up between the people that won based on how much they invested to begin with. So it's a prorated kind of system. And then depending on how many reputation tokens that you generally have, you will have they have a fungible token that you can get rewarded a salary for. So I guess the idea is also notice that instead of really worrying as much about how many people are on the network and that causing congestion, there are ways in which people have thought about governance to focus more on the voting structure and rather than transaction speeds and such, because for bigger decisions relative to the network, if it takes half an hour or even like half a day or like even a whole day or something, it might not matter, or people might not mind. So that's the difference between maybe the ways of thinking about creating a utility token versus a governance token.
So let's talk about some common tokenomics mistakes. There's two that are probably the most common. One is either intentionally or accidentally being a part of a pump and dump, or secondly, your token, even though you had fully positive and clean and non-malicious intent, someone finds an exploit and takes advantage of your currency. So pump and dumps normally occur because of big marketing pushes that are often influencer-led with no substantial product team or backing. So Yummy Coin, Bonfire, Elon. Bonfire is actually kind of picked up again. They got their team back together, so I might have to remove them off the list. But these are coins that they raise money, they do a pre-sale, and then they spend all of their money on marketing. And there is no actual real development being funded. The goal is for the token to go up enough for that to be good enough. And that's just not how the world works. When the market goes down, altcoins go down a lot worse than everything else. And these coins, just because you got pumped and dumped, doesn't mean the team is bad. Like I said, they can happen accidentally. So if your product goes viral without you intentionally trying to make it, like marketing is your job, right? As a new project, you want people to become aware of your project, so you are going to spend money on marketing. But sometimes that marketing can get either out of hand, or just the amount of people that are just exposed to the product just goes viral. And now you have a bunch of buyers coming into your currency, pushing it up, and you don't have the product or the rest of the infrastructure set in place to sustain that. And then the other example are exploits. So this is a really, really interesting one that happened not even a month ago with a company called Iron Finance. They're one of the most reputable DeFi companies. They've been around for a while. Their head developer, while he's anonymous, is still considered a very knowledgeable person in the space, and he's in a lot of DeFi conferences and stuff as a speaker. So Iron stablecoin was a coin that was worth $1. Excuse me. And that coin, that $1 of Iron, was redeemable for 70 cents of collateral, which was Ethereum in this sense, and then it minted 30 cents of Titan. So that was the system, right? They have a stablecoin that's worth $1, and then it mints Titan and redeems ETH off of the collateral. So what happened was Titan crashed dramatically. It went from being worth, I think it was $80, and it crashed down to $50 off of one sale. And then what happened was Iron lost its peg. So now when it's minting 30 cents when a stablecoin loses its peg, it means the stablecoin is no longer worth $1 or whatever value it's trying to be worth. So now this Iron that's supposed to be worth $1 is only worth 80 cents because the Titan that's being minted, people are selling instantly, and the Titan market is crashing. So now this $1 of Titan that's now worth 80 cents is still redeemable for the collateral, the 70 cents of ETH, and the contract mints 30 cents of new Titan based off of its market price. So what's happening is off of an 80-cent buy, people are able to mint $1 worth of value because that's how the system works. But because it's not supposed to be worth 80 cents, whales essentially did what's called a bank run. And they took advantage of that difference until the token crashed into oblivion. So this is a really interesting example of how one of the most reputable coins and stable coins that was coming up in the last like 6 months got destroyed because of an exploit.
So in summary, we basically just covered a bunch of different tokens, so from the U.S. dollar to Bitcoin to PlutoPepe to DevXDao, governance tokens, utility tokens, how that compares to traditional fiat and how it all compares to the original token overall. This tokenomics framework is useful. Obviously, it's not going to answer all of the questions, but to get people started, this is a really good framework to start to understand how to kind of list out ranges of how each of these blocks are supposed to interact, but also know that they are very interconnected as well. So how would governance and your like token policies and such affect the congestion of the network, for example? Right. So and with that, that's pretty much all that we have for the presentation. We didn't really go over any code, but we did leave resources for people to research and look through themselves when they have the time. So with that, that's the end of the presentation.
Yeah, I'm just flipping through the last few slides. So these are essentially just some extra resources for you guys to be able to read through and look through once the presentation is uploaded online. Besides that, thank you guys for listening. We hope you learned something. We have about 20 minutes left in our time. So if there are any questions, you guys want to talk anything tokenomics or about anything that we touched on during this presentation, or the floor is open to you guys.
Just a random thing to bring up. What did you guys think of Ethereum Max? Did you guys hear about it? Ethereum Max. It's like one of those marketing coins that you were talking about earlier.
Okay, Ethereum Max. Okay, yeah.
Yeah, and it's apparently just a simple ERC20 token. It doesn't really do anything.
Yeah.
But they were able to get like people like Floyd Mayweather to actually promote their token.
Yeah. I know. I've had offers like that come across my table for different coins I've worked for. I've had like Swaley, Trippy Red, like all these people. They're all just Instagram accounts that you can buy posts for. All of them have a price. So that's the thing. Like, getting Mayweather doesn't mean Mayweather bought any. What it means is Mayweather got a bunch of it for free.
Yeah, it's crazy.
Yeah.
And it's down maybe like 200% since like people were buying it. Oh, it's gonna be big. So they're all locked in with it. It's ridiculous.
Yeah, it's very common. There's a pump and dump pretty much every day.
Yeah.
Yeah.
One question: is it possible to get a presentation?
Yes, it's gonna be made available in like later today. I always make it there, but presentations are available in the GitHub repo here.
Thanks.
Yeah. So by the end of the probably by the end of today, worst case probably by the end of tomorrow, it'll be up.
It's usually day of though. I'll upload it. So if you have the repo starred, you can just pull it and just have it globally.
Okay, thanks.
Cool. Any other questions?
Did y'all hear Iron Finance trying to like build back its reputation? Like, what's happening with that? Like, how do you recover after that?
So it's the first bank run that happened like this, and like that I know of. So they're kind of like in uncharted territory where they like their contract broke, but the team didn't do anything dirty, right? So they're very transparent, very clear. They notified everyone to pull their liquidity, and then they dropped like a post-mortem event. And so now they can fix.
that notification was like 12 hours late.
Yeah, they were slow about it, but apparently their socials were like their Discord groups and stuff were a little bit better to at least tell people that there was a problem. They
Yeah.
just didn't know what the problem was for a little bit. But yeah, I can understand. It's kind of hard to be the company in that situation, right? Like your token that's, I don't know, worth like literally hundreds of millions is just like disappearing before your eyes.
Yeah, they had something where you could like redeem some stuff afterward. The link didn't work. Like allegedly, if I had crypto, I lost a good amount of bread on that, and it was like, what? Like I didn't get nothing back. So I'm interested to see on how they rebuild, like, or how they recover.
I was in their Discord, and I'm pretty sure they said that they had some other farming and lending stuff they were gonna release that was pretty much all built out. So they were gonna tweak it, and they were gonna launch a V2. And I'm pretty sure they said that everybody who lost money, we're gonna award you some government tokens of some kind.
Yeah, they could just do like a blockchain snapshot or something.
Yeah.
It was supposed to be that you qualified and that you could redeem stuff, but like I ain't qualified for that. But I mean, another question I have is like, what would you like? What is like something other, like, what are other like utility coins other than the PlutoPepe that are your favorite?
One of my favorites that I like first got into blockchain with is BAT, Basic Attention Token, the Brave browser token.
Makes too much sense. BAT's great.
Mm-hmm. It just makes sense, right? And their browser is great.
Yeah. Yep.
How do they run? Like I've never really understood that.
It's like Google AdSense, where like you put your ads, like you launch a website and you let Google put ads on it, and then you get some revenue. BAT basically awards users the BAT token.
And then content creators apply with Brave to become approved advertisers, essentially. So all the ads you're getting are all clean and like from reputable companies, and it's stuff that's tailored towards you. And if you don't want the ads, you can just turn them all off. And if you do take ads, you get paid for all the ads you're viewing if you do accept them.
Okay, that reminds me of AdX, which is like that, but like not through a formal application process, but rather just like a more decentralized way that you can integrate into your website using Ethereum.
Yeah, the integration of Brave is decentralized. The becoming an advertiser part is centralized.
Yeah, So
but to get paid on Brave, you need to go through KYC.
But it's like wait, to get your BAT out.
Yes.
What? Okay, so
they use Uphold as a wallet partner. It's like integrated, and you go through KYC with Uphold.
So it's really just advertisers paying them. That's where they get the money from to pay for their.
Yeah, it's a better way for advertisers to advertise, and it's a better way for users to receive ads.
Are they like their own blockchain? Or they own like their own?
No, they're on Ethereum. ERC20. They're one of the first ERC20s that got like any kind of usage. Besides BAT though, let's see. I guess BNB is a weird utility token. I only ever bought it the first time because of its utility, reduced fees. Reduced fees is a really interesting utility. It's like one that every single exchange, I think, like innately can kind of add if they're not free. I don't know why.
Does that, and like Pro does that too.
I wish like one cool thing I think that a DEX hasn't done yet, that if like you guys here are listening, is a way to use a DEX token to reduce your fee. So let's say
doesn't 1inch do that? I thought 1inch did.
I don't know, dude.
Or Bouncer definitely, like, I think V2 where they award you some Bouncer token when you do like a swap on Ethereum.
Well, if someone can fork it and get it running on BSC, that'd be pretty cool.
Well,
because like I guess like the main point of it is if you have a DEX token, let's use PancakeSwap. Let's say you have Cake, right? You have like $100 of Cake. normally there's like a platform exchange fee of 0.5%, right? And you pay it in whatever tokens you're trading. But instead, if you were able to add cake to your transaction and pay the fee in that, and it was instead of 0.5%, it was like 0.3%. And now the people providing liquidity earn cake instead, or like it could be sold. Like it's kind of like complicated because the liquidity providers are expected to be getting paid in the tokens they're providing LP with. You have to sell that cake and turn it into LP.
Okay. I didn't know if that was true though, because like I was doing some LP stuff on QuickSwap at some point, and I was getting rewarded in Quick.
You're getting rewarded in Quick and in the base. Normally that's how it works. So you earn trading fees, which is just like the fee. So if I'm trading BNB into BUSD, there's like the fee, right? And that fee just goes either to the BNB half or it goes to the BUSD half. That's how impermanent loss is built, is because one side is getting traded more than the other. And then, yeah, so if you're getting most of your base LP through that trading fee, and then they're boosting your LP with Quick. So that's how DEX APY gets so high. It's like the trading APY is like 5 to 10% off the trading fees, and then they boost it with Quick and make it 50% APY because they're giving you a bunch of tokens on top.
So can you look at the longevity of these high like APR like platforms? Like how do they sustain? Like how does it work? Because it's usually like thousands, and then they get a bunch of users, and then it like goes down. So can you kind of like break that down?
Yeah, DEX tokenomics are a little complicated because there's a lot of natural like downward price like movement like in the system because you're minting new tokens and you're giving it to people that are looking for profit, right? That's the point of yield farming. That's the point of farming it on a DEX, is you're looking for profit. So you know that those are sellers. Those are the type of people that sell. Because they're in it for whatever their base token, whatever they're really looking for. Right. That's what they're trying to earn. So if you're giving them their token, they're looking to sell it. So now you have to create enough utility and enough demand and enough burn mechanisms behind the token to keep that upward pressure higher than downward pressure. And
how often does that happen though? Like I see these farms on Polygon all the time, and they last like 2 days.
Yeah. Normally they move like pretty consistently with the market. Like if the market's going down, like the farm gets hit pretty hard. You might like you'll probably lose a decent chunk. But like I'm farming Banana and Polygon, and so when the market gets hit, my position gets hit pretty bad. But the LP tokens I have overall in the last like month have gone up like 20%. So the way it's working is I got like 1,500 LP tokens for providing Banana and Matic, and then as soon as if I wanted to withdraw, which I don't, but right now it's at almost 2,000. So in the last month, you gain that much more ownership over the liquidity pool because it's like auto compounding and it's reinvesting into the DEX again. I guess to go back to Shot's question though, to build a system like that has all those components of burning, utility, and you're still somehow like keeping demand, it's almost impossible for it to always go up, right? It's about creating a sustainable economy more than it is about making the token go up. So what you want is enough buy pressure to balance out the sell pressure. It doesn't need to go up. It can even consistently go down as long as there's strong liquidity basis for people that are earning to be able to sell into without dumping the price. And that's where a lot of people that are in tokens look at DEX tokens wrong. It's like you're farming cake, but most of the time you're just going to sell your cake unless you're in it for the long run. And then at that point, you're farming your cake constantly and you're just holding it and you're hoping for it to go up. So now you're just getting an altcoin in a different way. But if what you're doing as soon as you get it to sell it, now you have stable coins or you have ETH or whatever you're trying to get in the first place. So you're able to kind of keep yourself consistently earning like revenue. So for a DEX to be good, it needs that DEX token to easily be able to be sold for me to be able to sell like, $5,000-$10,000 of the token, not all at once, but over the course of a month, over the course of a year, almost every user is going to sell like a decent amount. Yeah. So I think that's where it comes from. It's a misconception of trying to make the price go up rather than create a healthy system.
That makes sense. Good. And then if you use the DEX token to pay fees, that should provide you a constant buying pressure.
Yes. And so while maybe it won't make the price go up only, it will help the overall market balance.
Last question. Have you guys looked at like Terra at all?
Very little bit. I think some people on the team might have.
They're the protocol people, right? Or Terra Luna?
Sorry?
Or like this is the
I was just reading some stuff, and there's apparently a lot of cool stuff going on with them. So I believe they're based in Korea, and they have this thing called Chai Finance, which is like Cash App or Venmo, but it basically uses their stablecoin. It's UST. And
okay, UST is theirs. Okay.
Yeah, US Terra, and then apparently because they're able to provide much lower fees and instant settlements, so they get users because merchants are willing to provide discounts, and that's just a really cool project.
Okay, that makes sense.
And then they have this version of synthetics where you can farm long or short on synthetic assets, and if you do it right, you can basically get a 200 APR because you're farming both long and short, and you're not losing money on the asset price.
Okay.
Just cool stuff going on there.
Yeah. Yeah, farming short is an interesting concept.
Yeah, I don't fully understand it.
I haven't looked into it enough to try to understand it. I guess there's like a bunch of different ways it could work. I'd be curious to see how they implement it though.
Yeah.
Tara's the one who reached out a couple weeks ago about DefiSummer. Actually, we should follow up on that. I didn't realize there was so much.
Yeah, they followed up on DefiSummer after it had started. Otherwise, Tara might have been part of this event.
Oh man, that would have been great.
Yeah. But we have DeFi Winter.
Yeah, and also
there's a winter too. Oh, that's pretty cool.
Yeah, it's still hush hush. It's under wraps right now, but there'll be more opportunities for you to engage with them if you're interested.
And
that's cool.
One thing I wanted to know is there like an because LP token price? Is there like an LP token aggregator that across platforms where we can
so LP tokens aren't tradable yet. Honestly, I don't know why not.
You can sell them with the price. Like they have of a like why isn't that a thing?
So
aren't they exchange specific?
Yeah. So for example, on Cake, when you provide liquidity, you just get Cake LP, right? And the router knows what the tokens are for. But if you just show that token to some other DEX, they're just going to see Cake LP because it all belongs to one router contract and one factory contract. So like the way they're created and the way they're minted is all under one.
If I'm transferring LP from one exchange to another, like for example,
that's why you have to migrate LP. It's not really transferring, right? They have like that migrate function. If you've ever done it before.
Oh, okay. You can't just move, even if they have the same even if they have the same pools. You can't.
If they have the same router, so if it's like someone that just took Pancake and only changed the front end, not the back end, kept everything the same, and it's connected to their liquidity pools, then yeah, your LP should just show up. Yes, like
different router addresses that use the same.
No, it has to be the same.
But wait, if you have the same router, then
it's the same DEX.
Are you double liquidity farming?
No. So having the same router would mean you're just pointing all your users directly to Pancake stuff. They're not your users. They're all using Pancake. So it's actually
you just built a front end then.
Yes.
I see. Is that common?
Yeah, it's really simple. It is common too. So a lot of like projects that focus on like farming or on like more yield stuff what they'll do is they'll bring in either Uniswap or PancakeSwap, depending on their exchange, and just move around the front end a little bit. Sometimes they won't even do that. Sometimes they'll just link PancakeSwap as their exchange page, and so that way, if users, because like swapping is a different focus than yield farming, right? So they're like, we don't care about that. We'll let them do their. We don't care about people providing liquidity, and we don't want to deal with that. We'll just use the built exchange to handle our users' swaps, and then they can use those assets on our pools.
That makes a lot of sense.
Yeah. So once you take your LP tokens, like for example, there's some like Polycat is on Matic. So if you go on QuickSwap and you get LP tokens, you can go there and it will read your LP tokens. It'll understand it, but only for DEXs it has integrated. So it has, I think, like 5 or 6 DEXs integrated. And so it can read, you can have a DEX read other routers and aggregate a usage for them, essentially. It's not impossible. It's definitely possible.
Very cool.
Cool. Any other questions?
No, not really. That was great.
Cool.
One more thing on Terra that's pretty cool that I think you guys might like. There's building this project called Mars, and it's like Aave where you can lend and borrow, but apparently you're able to use any asset that's on that blockchain as collateral for any other asset you might want to borrow.
That's interesting. That's gonna crash.
Yeah, I have no idea how that would work, but
that's gonna break.
The terrible idea.
Well, actually, it won't break. There'll just be a lot of liquidation.
Yeah, I mean, I might not be describing it completely accurately, but that's what I got.
Yeah, because I can imagine. I've thought about it before. Like, why don't you why doesn't someone just make a PancakeSwap version where you can just put in a contract address and it's worth something clearly, right? But
right.
Yeah, what it's worth and stuff like that is pretty different. Yeah. Cool. I think that wraps up the presentation.
Yeah.